Good morning. My name is Andrew Romans, and first, shout out to Randy Williams for creating Keiretsu Forum, not only amazing for the United States, but the whole world, and for Nathan and Brianna for perfecting it, like Japanese manufacturing, and Juan running just an amazing shop. So it's wonderful to be in a room filled with entrepreneurs, investors, wonderful executives at tech titans from earliest to latest in their career. So it's just wonderful. So thank you very much. We're actually on Fund 4 now. So time has passed and we're all getting older. Kids are getting older. We're on Fund 4 now. And at a high level, Brianna said it, but if you invested $100,000 in our previous funds, you'd be getting $700K or $1.2 million back. And that's net of fees and everything. So it's like, we're diversified and we double down. The second thing is, if you've invested in any of these startups, whether it's mattresses or drug discovery or internet or automation software companies, it takes a long time. And unfortunately, we're not vampires. We're not going to live forever. It takes a long time. And venture capital, Ken Goldman yesterday, I love that guy, was talking about how long it's taking. And secondaries, which I've been fighting for my whole life and used to be very, very involved in, is making it even longer to get your money out. So we've developed a way for us mortal people that are not endowments, insurance companies, the Vatican, or the New York Police Pension Fund to get our money back a little faster. So, one is, cash on cash 7x to, kind of 12x. That's a good thing. 2 is let's get our money back faster. And 3, I don't like the way that VCs in my career, and I've raised over $300 million as a founder before becoming an investor, that I had VCs that were not reading the packets before the board meeting. They were on their Blackberries, during the meeting, and they didn't introduce me to Larry Ellison and all these people they promised afterwards. So like their follow-up was pretty bad because they're on too many boards. And so our answer is, even though most of our money comes from this one sovereign wealth fund, a couple of huge families that are these, billionaire guys, we love the small check. So we say our minimum is $1 million for families and $250K, but Brianna and Nathan very intelligently convinced me to say $50K for anyone from Keiretsu. So we love a $50K check because this kind of factor of the VCs are worthless roadkill, damaging the companies they invest in. And what's much better is to get guys like Austin, Dahlin, all these people. We have maybe 30 people from Seattle. And I just love Seattle. What a wonderful place to come to, filled with amazing people. So one of our favorite places. Well, I'd love to give a talk about views on everything because I have quite a few opinions, but I didn't give me enough time. But it would appear that the economy is not doing so bad. I think it's not a bad thing to be optimistic as a venture capitalist, even though I'm becoming a pretty bad, grumpy old man. I've seen that before and it'll fail for the 10th time. It's like a graveyard just pushing off the cliff for a new startup. Whereas Mehran, my younger associate, he's like, oh no, that'll work. I'm like, no, it's never gonna work. I've seen 50 of these die. But anyway, let's move on. So what's gonna happen? 2020, of course you're not gonna sell your company with Anthony Fauci telling us to hide in your basement. And then 2021, why would you sell when they're offering you $50 million on a pre-money of what was that, 75 for the last one? Let's talk billions. So it was so easy to raise money in 2021, no one sold. Hindsight, we should have all sold in 2021 with multiples of 47x top line. Well, nobody did. 2022, Putin invades, Ukraine, and the multiples from 47x dropped to 5.2x top line sales when the normal state should be 12x. 2023, we're still in 2022. It's still 2022 right now, no one's selling. So that's 3 years of pent up, no exits. That kind of sucks. And I'll get to how we get to sell a little bit earlier and get some cash in our pockets because, damn it, I want to be a vampire, but it doesn't seem to be working out. Maybe I can go cyborg at some point and live longer. We will see. So investment thesis. We basically invest in late stage seed. So we like to see, basically, and we're software only. We don't do drug discovery. There's a lot of things we don't do. What we're most passionate about is automating human workflows and leveraging data. Kind of like the book or the movie Moneyball or the company Palantir. Basically, the locomotive is faster than the horse. The plane is faster than the locomotive. Don't pay somebody in Basel, Switzerland to read 100,000 documents on clinical trial data. Let the computer do it and connect it to data. And then let those people do something more intelligent and oversee that. It's this continuum of humankind that we have to automate human workflows. Have you ever been to the DMV? I mean, that would be so easy to fix. There's so many things that can be fixed. Basically, Palantir for every little idiosyncratic industry. How about real estate? How about healthcare? So that's kind of what excites us. So let's unshackle ourselves a bit with, some software. A lot of VC funds are like, woohoo, I made such a great return. It was one company. I'm not proud of I invested in Amazon and Google, made so much money. I'm proud of the bad companies we invested in and still made a 32x return on. That's impressive. But part of how you deliver these returns is not have one hit company in each portfolio, but have a bunch that return the whole fund. That seems to be what's happening. So I love this slide. It's our strategy that does well and when the economy is good and does well when the economy is bad. But net, we like late seed. We like Series A. When you get big multiples on that, meaning like you invest at this valuation, you exit at a much higher valuation, and the multiple is like 20x, 30x, 50x. And that really delivers returns for everybody. If there's one thing to know about angel investing or VC investing, it's diversification, portfolio construction. It takes a long time to get out in general. That's a problem. And most mortal people don't diversify enough. And then most angels were somehow brainwashed into thinking they should invest earlier and have a longer holder time with a higher death rate because it's early than benchmark capital. Those nice boys should have lower risk, shorter time horizons. Why? Because they're investing money from the Vatican or something. So that's a mistake. So we help angels get into the benchmark deals that are late seed and Series A. After kind of that Series B inflection point, companies are not a secret. Investors are not adding value. It's like whoever's going to pay 1 basis point higher, let Yuri Milner from Moscow invest. Nobody cares. But we have access because we have insider trader information, which is legal, information rights and pro rata equity rights, which is amazing. But we invest via SPVs. So our fund treasure goes for the big multiples with low risk, kind of low risk, high reward. But we invest in Series B, C, D, that last round before the IPO or M&A, which is expecting like it'll double in a year, or if it drags on for 2 or 3 years, it'll do 4x. It won't do better than 4x, but there's typically a perceived zero risk of it going down. Because we invest in those SPVs, special purpose vehicles in the late stage rounds, not fund money, but all of our LPs get access to them, we said, why don't we sell a little bit of equity, 5% to 25% of what the fund owns in that one deal, to deliver some money. So I jokingly say, don't do Jerry Maguire, show me the money, wire me the money, wire money, cash. So when the company, if we had an entry point of like 8, 10, 12, 30 million, and now they're raising at 2.5 billion, it's offensive, unethical, and wrong to not wire some money to Brianna and Nathan, who, by the way, are LPs in our fund. And they have real lives to live and could use some cash. There's plenty of ways to spend money. So we deliver the cash in those later rounds, but we say to each LP, you have 3 options. 1, let me wire you the money. That's what I recommend for everybody. 2, I'll stay in it because I think they're going to raise another 100 million, a hundy. They can then hire more people, automate some more, save more money, make more money for their customers. It'll double in a year. So don't wire me the 50K back. I'll wait a year, it'll be a hundy. Well, I don't think you should do it, but we allow it. So you can recycle your exit consideration into the SPV. That's option 2. Option 3, recycle and put more money. Say, I want to put 500, I'll get $1 million back, or maybe 2 million if it drags on for a year or 2. So that's how we're delivering money back faster. Basically, everyone said there's a recession every 10 years. So it's been forever that I've had to pitch people, how do we survive a downturn? So we've always been built for it. So we have a few methodologies that we've learned over the years to benefit when the market goes down. I've got an article that I write every time the stock market crashes. I've dusted it off a couple times. Love to share. Here's the quick cliff notes. Valuations down, good thing for the investor. Will the economy recover within 5 years where we pay no tax because of QSBS? Yes, it'll come back in a few years. I think that it's still 2022 now, but hopefully by next summer, we'll recover. Do you think we're going to exit within a year? No, we're adults. It'll take longer. So, meaning it's a great time to be investing now for a million reasons. So I already talked about the options. Now, especially people that are involved here, you love a glass of Chardonnay, you love to not sit at home drinking alone, and you like to be part of a community. Well, we give that to you too. So we have events in lots of ways that engage. And we even think the idea of me being on 50 board of directors where they say, do we deliver these stock options and where do we park the bicycles? I don't really want to be on 100 boards because I don't think I'm helping. I think it's bad for the startup, bad for my family, bad for the LP investor. We'd much rather get to know you, figure out what your magic superpower is, have you meet these entrepreneurs, and have you take a board seat, have you advise us, or be passive, but lift up your telephone once every 10 years and make a magical thing happen for the startup. Do I have 4 minutes left?
Yes, sir.
God, normally I want more time. I feel like I'm done. Anyway, so we, part of like mathematically, statistically getting lucky is being in a deal stream. Basically, when I raised my first funding round, it was 15 million as a young guy, and I'm on stage pitching or talking about my startup. And you get off stage, and all these founders say, "Hey, could you introduce me to Scott Sendell and Dick Kramlich at NEA?" And I'm like, no, maybe. But the point is, the deal flow started coming immediately once you're raising money, and the deal flow keeps coming. So it's good to be in a deal flow stream. It helps to make a lot of mistakes and get a little bit better as you go. But we basically fill our days with a quarterly Zoom or face-to-face meeting with other VCs where we know what they're looking for and we show them our portfolio companies. And then we tear down, like Mehran will tear down the whole portfolio of a VC that I'm meeting with before I do and say, these ones look interesting, ask about them. And so they show us their deal flow and we show them ours. And the number one cause of death for a startup is running out of cash, okay? And you get that from like, I don't like government money, but you typically get it from customers or investors. And so we make sure that if you get funded by us, you're gonna be introduced into the venture capital machine and get funded by a big VC on the next round. And we like that up curve to SPV in and then get money back out. And that seems to have better outcomes in my opinion. So we've co-invested with a lot of these, let's say, worthless roadkill VCs. I've written books, I've got a podcast, they let me get in fights with people on TV. I'm the defender of the startup, and these other guys from like the Midwest are like against the startup usually. That's how it goes on TV. I just love the network. Wherever humans live, every continent, we have LPs. So it's actually quite a global thing. It takes a village to raise a kid and more than a village to raise a startup and get it through. It's the closest thing to combat, as Chuck Newell from NEA, co-founder, said in my podcast, and he's a real warrior. Hamburger Hill, he lost half his men on that day. Amazing guy. And so startups should be treated like combat. And so it does take a lot of people to get to the finish line and come home alive. So with that, I yield my time to the lovely entrepreneur that wants to pitch and get your money.